everyone. Welcome to the stream. I'm Alpha Dad, and today we're diving into my market analysis for the week. I'm going to start with my portfolio, last week's recap, and then my perspective on the unfolding volatility events going on in the market using QQQ, Tesla, and NVIDIA as my key indicators, as well as a brief dive into the VIX. First, I'm going to give you my perspective. I am long QQQ, long NVIDIA, and accumulating NVIDIA. I am short Tesla, and then I generally carry positions in short-term treasuries to generate yield. I am long VIX calls in the February contract and have been moving in and out of long and short volatility positions. I successfully closed a VIX long put on the front month contract for a profit on Friday. In front of me right now is actually the full scale VIX volatility index. Friday saw a large sell off and a recovery boost in equities, which I had anticipated after two full waves of volatility moving into the top end of the existing volatility channel. It became too enticing to just go ahead and sell and buy puts, to realize a little bit of profit on the move and also to hedge my already hedged QQQ position, which represents 80% of my portfolio. The look on lower time frames appears to be a breakdown. There's a clear breaker block up here, and then what your neophyte trader would interpret as a breakdown in volatility. What this actually is where I closed my long put positions because this is a buy side liquidity run. This to me is a fake out that precedes another wave, a significant wave, in fact, of volatility moving into the sell side liquidity, buy side liquidity, that exists up here. There are a lot of less informed traders that are long the short VIX and don't understand things like options hedging or risk management. So there's a lot of naive traders that are about to get pushed out through here. Why do I think volatility is coming? It's Tesla. Tesla is the primary reason. It's going to be across QQQ in general. We just had a NASDAQ rebalancing, and for people who don't understand, rebalancing means you take your most profitable positions, you trim them, harvest the profit on that, and then buy your underperformers. It's a very simple concept in modern portfolio management theory, and yet a lot of people don't seem to understand this, have continued to try and buy Tesla, who is up 55% this year, and is now flashing the most obvious head and shoulders formation that I've seen in recent days. Tesla hit all-time high at the top of this ascending channel. The top is only clear now, but the bottom is defined from its initial breakout back in October. This is the top percentile, and it's now in the trading range only at equilibrium price. I'm not going to buy anything here. In fact, I bought puts up here when I noticed that the price action was struggling to retake the 75th percentile structure, and then I saw the obvious head and shoulders pattern forming. My theory isn't just based on chart structure. If you look at a couple different things, the Tesla January 17th, 2025 contract, you find a dark pool print of an unusual put. There are 5,000 puts at the 430 strike that are missing from the open interest. That means 5,000 puts representing an intent to purchase 500,000 shares of Tesla at approximately $200 million price that someone is short are now aggressively underwater as Tesla has rejected the 430 level quite substantially. You've got $200 million in what is almost certainly naked short bullish risk reversal that is being used to drive the market maker to buy more Tesla stock that got caught flat-footed by someone who is frankly a better trader, who probably had insider knowledge that the Tesla recall was about to occur. and bought those puts at a discount. Anyway, the minimum drawdown I see is to the volume gap visible on the weekly time frame at 390. This also happens to be a significant level as it is Tesla's previous all-time high. I am targeting that probably for initial. I'm probably going to take profit on my puts here simply because I generally find that profitability in long gamma is not a lengthy visitor. It's entirely possible that the implied volatility, which is absurd in Tesla right now, if you will look at the volatility chart in a minute, is totally overdone, and you'll see volatility sellers come out and create the lift through volatility selling that will end up creating the Santa rally that people have suddenly written off, except that there's a market mechanistic explanation for why such events tend to happen, which is that all the puts that everyone in the market has suddenly bought in their rush to hedge start decaying in value. And because market makers delta hedge, they will end up buying the underlying to hedge the decaying deltas on their short puts. Anyway, I'm short Tesla. This is why. This is my price target. That's my rationale. I am long NVIDIA. I'm accumulating shares. I'm going to try and get as many as I can while it remains at a discount. It's amazing that I even have to make the case for NVIDIA, given that this company was worth $1 trillion last month, but here I am doing it. The reason is because there's an obvious fake out that has been created on the chart, which is this presumptive head and shoulders pattern that has taken months to unfold. However, what I also see is that NVIDIA is, in fact, right now at the bottom of a more or less well obeyed price channel that is seeing buying interest lifting the price, obeying the channel. I'm buying down there. I know others are buying down there. I'm going to continue buying with the caveat that as Tesla closed down 3.5% on Friday, NVIDIA closed up. I believe this is a false breakout. The NVIDIA channel is still descending, and what I see here are relative equal highs. If you know anything about, or relative equal lows, if you know anything about Inner Circle Trader, this is probably a liquidity run. I believe that the NVIDIA bulls are being coerced into starting to buy calls, sell puts up through this range, this inefficiency over the point of control of this large distribution block. I believe that when Tesla begins to break down aggressively and the rest of the NASDAQ begin to sell off as well, which is healthy, they are all quite profitable at the moment, that we will see a sudden reversal that seems to confirm the fears of everyone who suddenly has forgotten that NVIDIA is one of the strongest performing stocks of the last 5 years. They will believe that it's time to sell everything that they want or that they still are holding if they want to keep the profits because they only got in recently and it's going to tumble to $77 or something like that. And it's going to look really scary. And I'm going to be sitting there soaking up NVIDIA, waiting for the inevitable reversal to the upside. That is the breakout, stop, run to bounce. If you look at NVIDIA, this is nothing but absolutely stellar performance. Strong buys, 1 year price targets, 30% up. I am literally putting a client into 60% NVIDIA because I think it is the safest possible stock that I could put someone in a core position, which is a principle of things that I trade. All right, moving forward. QQQ supports this thesis. I am long QQQ. I am hedged with a collar, net risklessly. I made money on the move down. I bought puts at the top prior to the volatility collapse or the volatility expansion because I well, saw it coming. I rolled my collar profitably when we hit the bottom at this 510 volume imbalance, which I was also targeting, and rolled them so that I am now net guaranteed profitable on my large QQQ position and in position for upside. Before that happens, however, I'm anticipating a couple waves of volatility. We have the VIX sitting here looking like it's breaking down, trying to coerce people into going short so they can get more of the move before it returns to historically unusually low levels. But that's not going to happen. We have liquidity up here. We've already performed a liquidity run into this, but we still have this entire region that was generated as part of the yen carry trade unfolding. This is where my out of the money calls are. People sold calls and bought puts up here, and market makers need to hedge their risk. So I'm anticipating actually a pretty significant volatility bounce here. I'm still long. I believe that at some point everyone will think that the end is here, everything is going south, and then what will happen is that the trader who got stuck flat-footed net short here is going to fully capitulate. Volatility sellers are going to come in. They're going to buy the dip. These long puts on Tesla are going to start buying the underlying and hedging their position. And then we're going to see the inevitable Santa rally that occurs as volatility decays. All the overpriced puts and hedges that have flooded into the market. And oh my goodness, you should check out QQQ if you want to believe, if you need proof. If we go out to the February contract, 60 days out, the market is absolutely flooded with puts. And this does put us in a dangerous situation. We could find ourselves in a net negative gamma scenario where market maker hedging dynamics push us way, way down after 500. There's very little by way of support in the form of people closing their puts for profit until around 460. So this could be, there is the threat, at least, of an absolutely brutal drawdown. I think that's pretty unlikely, to be honest. The market is threatening it. I am hedged against that possibility. So if you're not hedged, know that the chart supports the possibility. But what I think is a lot more likely is that the market is looking to resolve these inefficiencies in trading, these various gaps. This was the Trump boost and subsequent December enthusiasm that has been part of my hedging dynamics with QQQ. The descending channel that we're in now seems to suggest to me some continued consolidation, maybe violent moves even through this range. I could see us going as far as, well, around 480, 495. If we break down to 450, I don't know if you should buy or not. Maybe that's the best buying opportunity you can imagine. This is a low volume zone, so maybe that's where you should be waiting for the dip to go to. Maybe not. I do know that if we get to here within the next few weeks, that volatility will be extraordinarily high to levels that are generally not sustainable. So uh, we could see something like that. It's not impossible. Um, we'll just have to see. Generally speaking, though, I suspect that implied volatility is going to outpace realized volatility. We saw a 4% drop down on QQQ in a single day, but then this agonizingly slow movement of price through these two market inefficiencies, one at 524.40 and the other pinging the direct bottom of the channel at 510, which is where a whole bunch of risk reversals were dropped, including mine, and then I re-hedged at the top at 524 for a more favorable set of rates. Anyway,